Hello, my name's David Runciman, and this is Past, Present, Future, the History of Ideas podcast. Today, in our series on ideas of globalisation, I'm talking to the economic and political theorist Leah Downey about the history of central bankers and central banks, and one bank in particular, America's central bank, the Federal Reserve, the Fed. Is it possible to serve American democracy and protect the dollar and serve the interests of the international economy? And what happens when all of those things start to come apart? Leah, we should probably start this story after the First World War. We're going to take it all the way up to today, but as we've talked about already in this series, the First World War was an absolutely massive disruption of pretty much everything that people who thought they knew how the world worked believed in. Disruption of trade, disruption of finance, disruption of the gold standard, never mind the war itself. So when the war ended, is it possible to say how central bankers understood their role? Do you think the leading central bankers thought their job was to kind of get back to a pre-First World War order? Was it to get together in some way and sort of find some common understanding in this world of insane nationalism? Do we know what they thought their job was?
I think the way that you phrased the question is exactly right, in the sense that there was this huge disruption and the immediate desire was to return to some sort of semblance of stability, right? And you can see that in the actions of the major central bankers. So there was Benjamin Strong, who's very famous. He was, of course, the president or CEO of the National Reserve Bank of New York at the time. And it's important to remember here that the Fed, the whole Fed system, right, was only founded in 1913. So right before the war explodes onto the scene, right? So it's immediately thrust into this sort of international chaos. And so Strong was a very prominent personality at the Fed. And he, during the war, formed quite a close relationship with Montague Norman, who was the governor of the Bank of England. And the two of them became sort of brothers in arms in the financial world governance. Strong and Norman both pushed really hard to go back on the gold standard, and they both were super integral in the founding of the BIS.
So just to be clear, the BIS is the Bank of International Settlements?
Yes. The Bank of International Settlements, which was founded in 2930, so actually just right after Strong died. But he was integral in its founding. And essentially, it's an international central bankers bank. So today, most people think of it as a sort of node for coordinating governance of the international financial system, right? So central bankers from all over the world, I think there's 63 member central banks, and they meet there like 6 times a year or something, so very frequently. But at the time, it was actually set up with the explicit intention of technocratically, apolitically executing Germany's reparations payments after World War I.
So it's kind of remarkable in a sense that it still exists today, given it had a very specific remit. So it wasn't created in order to do globalization or anything like that. It was created in order to facilitate something very specific, which was Germany owed a lot of money to the people who defeated it after the war.
I think the truth is it was probably a bit of both. So like there is a proximate cause that was a convenient way of sort of getting the project off the ground. But the sort of background that is revealed in the debate about the founding was there was a lot of debate about, is this actually going to impinge on national sovereignty? Are we establishing something that is going to kind of run away with its independent powers? And, in fact, when the BIS was founded, it was explicitly modeled off of sort of the domestic idea of central bank independence at the time. So actually the relationship between the Treasury and the Bank of England was an explicit analog. But it's important to note there, right, that at that time, central bank independence was very different to what we think of it as today. Because at that time, most central banks around the world, including the Bank of England, were just private institutions. So that form of independence was a different model to the one we talk about today.
And did the central bankers, so there's Strong and there's Montague Norman, did they see themselves as a kind of club? I mean, did they think that they knew things that no one else knew, including the politicians, and it was really important that with their perspective, they had an opportunity to shape things independently of politics? Because that is an early forerunner of whether it's the reality or just the image, how people see central bankers today.
Oh, yeah, definitely. I mean, there's quotes all over the place from the debates at that time where it's we need people whose judgment is more sophisticated about the international financial system than the masses and the people who are attached to the masses, i.e., elected politicians. So there's absolutely that belief at the time. But I think it's a mistake to think of it too conspiratorially, right? Like, I think these people think they're doing the right thing. They believe the capitalist economy and sustaining financial stability is in the public interest. And so they are self-conceiving as acting in the public interest. But it is pretty clearly not democratic in your sort of standard understanding of that system. So they're absolutely trying to insulate policy making to some degree in an area of expertise. I mean, I think what comes later is that the BIS flounders actually in World War II in the context of the Nazi regime, and it crashes on political rocks, right? Like it fails to maintain its apolitical status. And as a result, what you get is a sort of global governance regime. I mean, we can talk more about this later, I suppose, but a global governance regime that's rooted in domestic central bank independence. So you don't get the sort of centralized body, or they still coordinate, but it's more decentralized than perhaps Norman and Montague were originally hoping for.
And when you say it crashed on political rocks, my understanding of it is basically the problem was the Nazis used it in order to get gold and wealth out of the places that they had taken over. So this Bank of International Settlement that was set up so that Germany could pay its First World War debts becomes a vehicle for the Nazi state to move money around as it conquers parts of Europe. I mean, that's not just political rocks. That is the opposite of what it was set up to achieve.
Exactly. Essentially, the Nazis, I mean, the first instance, I think, was Czechoslovakia, and they just forced the Czech political body to contact the BIS, essentially at gunpoint and say, give the Nazis our gold. And the BIS, in full knowledge of this, says, well, we're apolitical. We can't deny that for political reasons, that these are the people in charge and they're asking us to do it. So it was sort of looting via the international financial system.
Clearly by that point, but would it be fair to say at some point earlier than that, the central bankers had come to understand that if the mission after 1918 was to return to a pre-1914 world, that was effectively impossible. So we want to get back on the gold standard, but the gold standard found us again in the 30s, the Great Depression, the rise of international tensions, what we talked to Gary Gerstle about, the rise of tariff wars. There is no going back to the first, as it's now sometimes called, first golden age of globalization. They must have twigged before the Nazis were putting a gun to the head of the Czech bankers that wasn't happening.
I think that's right in, again, kind of in the proximate sense. Like they gave up on this idea of the gold standard, right? And the kind of institutional formulations that existed prior to World War I. But the same concept of a kind of global coordination amongst financial governance bodies in order to sustain the necessary infrastructures and stabilities to promote global financial life has definitely persisted. I mean, you can see this, like I'm most familiar with the Federal Reserve case, but there are huge internal tensions in the governance of the Federal Reserve about what is our job here, really? So is our job to sustain the stability, effectiveness, and efficiency of the domestic financial system, and therefore really the international financial system, because the two are so bound up and increasingly bound up over this period? Or are we actually just a state public policy body, that happens to have the remit of the financial system, in which case we're much more embedded in domestic politics. And that push and pull goes on throughout the whole period. And Benjamin Strong was the sort of first one to say, I'm definitely on the international side of that dichotomy. And he was much more interested in coordinating with Montague Norman than he was with any U.S. Treasury Secretary, for instance. So you get the push and pull of that. But I think in the end, more or less, Strong's approach wins out. It just doesn't return in the same way, if you see what I mean, sort of institutionally to the prior picture.
Is it possible to say how much actual, I don't know whether it's the push or the pull, but to what extent Democratic national politicians pushed back against this. I guess it's the push. It's the pushback and complained about it. So, in the British case, for instance, in 1925, Churchill takes Britain back onto the gold standard, strongly influenced by the Bank of England against the advice of people like Keynes. And it's a disaster. I think it was recognised. Initially, it was thought to be a triumph, quite quickly seemed to be a disaster. And its disastrous effects include not just economic, but political consequences domestically. To what extent were there politicians willing to say, this is not how this should go? We shouldn't have elected chancellors of the Exchequer doing what the governor of the Bank of England says. The governor should be doing what particularly progressive or even left elected politicians want.
You definitely do get that. As time goes on, who's making the argument changes, right? So, for instance, in the Fed case, when the Fed was first founded in 1913, it actually had a 20-year charter. And it wasn't until 1927 that the charter was extended indefinitely. When that happened, it was a sort of rogue move because it wasn't a bill where that was the aim of the bill. It was an amendment added to another bill, but it stirred up a lot of frustration. And there's my favorite example of this that's sort of revealing, actually, of the odd nature of the Fed itself is that there was a senator from Iowa who came on the Senate floor, and he says, look, more or less, I'm paraphrasing, but I'm not going to begrudge the financial system their bank to help support them and secure their interests. But farmers should have one too. So the idea was already there that this is not an institution that's sort of set out to pursue the interests of the entire public, so defined by democratic politics. It was a sectoral sort of private-public arrangement. And he pushed back on that. He obviously didn't win what he was interested in. Then later on, you get more sort of push and pull from within the Fed. So as I was saying, you've got Benjamin Strong, who's fully on the international finance stability picture. But then you get somebody like Mariner Eccles, who came in and reconstituted the Fed in the 30s in partnership with FDR. And he's much more interested in coordinating with the elected branches of government. So there's a push and pull there. But then later there's Burns' leadership, which most economists now would say was bad news, right? He was too in the pocket of the president. But there's a push and pull within the Fed. I think that pretty much comes to an end, though, in the 70s. The 70s sort of put a firm stop to any pushback on the idea that there should be more democratic guidance of the Federal Reserve, for sure.
So before we get to that version, which I think is what most people have come to understand by independent central banking, there is, well, you've already touched on it, there is another world war. But then there's also the story of how these central bankers, but also how their governments came to understand their role in the aftermath of the Second World War. So the Second World War international architecture, Keynes is going to win some, not all, but some of that argument, or you're looking a little doubtful. But anyway, we're closer to something that he's at least integrally involved in. He's not just being ignored by politicians. How do you think the Fed in particular understood its role after the Second World War? The crucial difference among many, one crucial difference among many. After the First World War, who was the leader of this club? Was it the Bank of England? Was it the Fed? The Bank of England had been around for a long time. The Fed had been around for 20 minutes. Yes, financial power had shifted, but no one knew quite how decisively yet. In the aftermath of the Second World War, there is no question where global leadership lies in this arena. So how did the Fed understand its role now and under Bretton Woods, what was going to be its absolute anchoring role in this system?
That's, I think, exactly right about the difference between the sort of aftermath of both world wars. I mean, you're right, of course, that Keynes was very influential at Bretton Woods and in participating in designing the arrangement that came into being right after the Second World War. But of course, Keynes showed up at Bretton Woods with this quite developed proposal, particularly that included an international currency and an international clearinghouse, and essentially an academic proposal that made perfect sense for enabling the rebalancing of the international economy, recognizing that exporting countries benefit from those who import and so on and so forth. But of course, political power just didn't permit that. So the U.S. was on top big time after the Second World War, and it just wasn't going to fashion an international financial system that didn't reflect that fact. So that's pretty much why you end up with the Bretton Woods system, in which the US, of course, is the pinnacle of the system. It's kind of interesting in today's context because there's a lot of discussion about, is the dollar going to remain the reserve currency, the preeminent currency in the world, or is that going to shift? And there's some discussion of, is this a moment where something like an international currency, Keynes's proposal, could happen because the U.S. might recognize enough that it's on the wane, that it might want to solidify some sort of system where China doesn't just sort of sit atop the pedestal next, but China doesn't have the power yet in order to resist that. So are we in some sort of perfect moment where we could get something like that? I'm not so sure. I think it's quite inherently unstable, just as it was then. But I think the main fact is that what happened was we had this Bretton Woods system where we're using gold, but quite quickly that wasn't sufficient, right? We run into the Triffin dilemma. We run into this desire essentially for globalization and global trade to take off, and the system can't permit that. So what do we get instead? Well, we essentially get what Keynes wanted in the form of an international currency. It's just the Eurodollar, right? It's just the dollar starts to take that position, and it's not governed by any politically decided on, politically intentioned system. And that, I think, is why we end up in this crazy Frankenstein system that we have today, where we've got effectively an international currency in the form of an offshore Eurodollar governed effectively by a global system of financial governance that is decentralized and relies on central bank independence in every country. So it's informal and decentralized, which of course makes it unstable.
Just say a bit more about the Eurodollar. I've got a specific question, but for people who aren't familiar with it, it's a very misleading name in a way.
It's a terrible name. So it's just any form of offshore money, right? So the euro prefix just means offshore. And then the second bit tells you what kind of currency you're talking about, right? So a Eurodollar is any US dollar that's created not in America. So yen that's created in Mexico would be called euro yen, or a euro created in India would be called a euro, right? So it's totally ridiculous, but that's what it means.
And when you say, just to be clear, when you say created, so a dollar, some people might think, well, how can you create a dollar outside of the United States?
So essentially, it's a bank that says, you could walk into a bank in London and say, I would like to open a depository account and I want to have dollars in it. And the bank can do that because essentially all the bank is doing is promising to give you dollars when you come and ask for them in exchange for whatever you've given them originally. And so it's really just a financial transaction. So in a sense, they're promising to deliver dollars at a certain time to you upon request. The history's sort of interesting, right? So it started at the same kind of time, post-World War II, where there were states, particularly the USSR and actually China, I believe, that were trying to essentially avoid U.S. sanctions, but they wanted to hold dollars nonetheless because dollars were the currency of, international trade. So banks in London offered dollar-denominated accounts. But essentially what you have is dollars created and used where the U.S. state is completely uninvolved, right? So there's no formal regulation on these dollars. So the U.S. has no regulatory power to require these banks that are issuing dollars to do anything in particular because they're, of course, in a foreign jurisdiction. And there, at that time at least, there was no formal backing by the U.S. state because, of course, these banks that are issuing dollars are not U.S. banks, so they don't hold accounts at the Fed. So they can't come to the Fed in a moment of crisis and say, I really desperately need dollar liquidity or else everything's going to fall apart. Now, of course, we later saw in the 70s and then in a big way in 2008 that when things did go down the pan and those foreign banks did desperately need dollars, they were able to get them from the Fed via their own domestic central bank through Federal Reserve swap lines. So essentially, the Fed pretty much decided in 1974 with this BIS organized communique to informally back the Eurodollar market because there was a bit of a wobble in the market in the early 70s as a result of the oil crisis. And the BIS met and they issued this communique that effectively says, don't worry, guys. If anything comes, we'll take care of it. And that made sense, actually, because it was the Fed itself under William McKenzie Martin Jr., the junior, in the 60s, who facilitated the explosion of the Eurodollar market. He thought it was a good thing, so he promoted it and actually established these swap lines early on to promote it because he wanted the dollar to be the effective international world currency. And here we are today.
So that, in a way, is my question. It's probably just a hindsight question, but after the Second World War, they're not going to go with Keynes's proposal to create a new international currency because America is not going to give up its preeminence in this world, and it's going to create a system where it is the anchor for that system. But with that comes responsibility. But at the same time, it sort of feels like the logic of this is if the dollar is going to be a kind of proxy global currency, inevitably we're going to lose control over it because it won't be a global currency if it is completely anchored in the United States. So if we do lose control over it, we are going to be the anchor in a system over which we do not have an awful lot of control. And that's going to create all sorts of dilemmas and problems that we see right the way through to today. Is it just hindsight to say, shouldn't they have twigged it might go that way? Because that basic flaw, it seems to me, which is will be a kind of global currency, but it's still going to be an American thing. Well, it can't be both. It just can't be both.
I agree with you. I think it can't be both if you're adopting a political theorist perspective in which you're supposing that they think that for it to be domestic, it has to be embedded in domestic politics. But of course, back to Strong in the beginning of the Fed, they just didn't think that, right? They thought it's actually our job to sustain the effectiveness and efficiency of the financial system. And by the time we're in the 1960s, Martin's thinking, well, the best way to do that is to make sure the American dollar is working as an effective international currency. And so let's promote this, Eurodollar market. And so I think they have a different mindset. And that comes partly from the history of the founding of the Fed and the way that it was set up and who owns it and who's running it. But essentially, it's never been a classic state institution rooted in public power and therefore in pursuit of the public interest as defined by domestic politics. And so that tension has just persisted all the way through and definitely exists today.
In the 60s, at the start of the 60s, I can see why. So the Eurodollar exists by the start of the 60s. America is in a very, very powerful position, and domestic politics hasn't quite come to bite yet. But by the end of the 60s, two things have happened. You've got a war in Vietnam that's about to go south and is costing an awful lot of money. And you also have a different domestic political agenda. You have a Great Society agenda, which is expensive. And so there are domestic pressures on the currency. And it's going to become harder and harder to sustain its anchoring role in the international system. Inside the Fed, was there a feeling we really need to insulate ourselves from these domestic pressures? Do you know how the argument was playing out by the end of the 60s, given where we're going to be by the end of the 70s? Was there a sort of foreshadowing of it?
That's a good question. I don't have a sense of what they were thinking exactly in that moment. I mean, I know that there was an active sort of post-war, there was a hangover, of course, of how much are we going to be tied to the domestic political institutions, right? So during the war, famously, the chair of the Fed announced, we're going to just support the government in its financing needs. So we're going to make sure that they can borrow at a low rate. After the war, the Fed started to get antsy about that, right? We don't want to do that anymore. We think that's inflationary. This isn't our job. We're going back to our effectiveness and efficiency of private financial markets world. And of course, presidents didn't like that because they were like, well, we want to borrow and spend and do all these things. So there was tension there, so much so that in the sort of scholarly and practitioner history of this time, right, there's this thing known as the Fed Treasury Accord, which was a bit earlier than your question. It was in 51, I believe. But if you read it, it's like 3 sentences, and it says nothing really. But it's widely recognized as establishing contemporary style Federal Reserve independence, where it was sort of like, we're not doing this anymore. We're not going to do as you tell us to do. So that's really the moment where there was quite a severe break post-war, and they never looked back. So they haven't coordinated policy actively, I don't think it's fair to say. Some people would say, in 2008 or in COVID, but really I think the Fed's driving those pictures. And in the case of COVID, you've got the Treasury Secretary signing off, but it's not anything close to the president coming to the Federal Reserve Chair and saying, look, I've got these policy aims and I'm going to need a little bit of flexible support on your end. That's not really happening post 51, I don't think.
So what then changes at the end of the 1970s, which is conventionally the start of the era that's called the era of central bank independence? Is it the case that what changed is outside of the United States? If 51 is where there's at least an informal understanding that they're not going to do what the politicians tell them. Well, in Britain in the 1970s, there was a clear understanding that you do what the politicians tell you. In fact, the Chancellor of the Exchequer can set interest rates and so on. And so, a long way to go before we get to formal Bank of England independence. But the late 70s is still held up as a moment, including in the United States, as I understand it. So if 51 is one break in this story, why then is the late 70s another break?
Because in the 70s, it starts to hurt. So in 51, there's a sort of inside the beltway, like, I'm not doing what you're telling me to do kind of argument. And so then we have central bank independence of one sort. But then you get to the 70s and the oil crisis shock and all of the pain from that inflation. And at that point, the president doesn't want control of the Fed anymore because they're saying, your fault, not mine, right? This is when you start getting discussions about central bank independence as a mechanism where elected officials can sort of scapegoat the Fed when things go wrong. And the Fed, of course, turns around and says, okay, I guess I've got to do something. And independence starts to bite when interest rates start skyrocketing. And so I think that's generally the moment, right? Then we get the Volcker shock, et cetera. Like, that's generally the moment where people will say, this is where we really see central bank independence because the proof is in the pudding, right? The central bank actually acts sort of in a painful way and in some sense against some of the priorities of the elected branches of government.
But the Volcker shock, so named after the chair of the Federal Reserve then, in the face of seemingly entrenched inflation, raising interest rates to a point where it is sufficiently painful that it's possible to get a grip on it. This is with the tacit consent of at least the White House, isn't it? Or is it not? Because we're going to talk about the White House versus the chair of the Fed and where we are today. I don't know, I'm asking you, but how would you interpret that relationship at the end of the 70s? So it's not a story that begins with Reagan, it begins under Carter. It's painful for politicians and it didn't probably do Carter any favors. But how would you understand that relationship back then?
I think Carter wasn't going to try and haul in the Federal Reserve Board or the FOMC and tell them what to do because that had already been tried, right? Nixon had tried that and it had backfired right in his face. So I don't think he was going to try that. So Carter took a different tack and has tried to employ the sort of Emergency Credit Act and get engaged in managing the inflation from a different perspective from the fiscal arm of government. How much had he said, wink, wink, nudge, nudge to Volcker? That's beyond my expertise. I don't know the answer to that question. I mean, I know that some people say there were sort of regular breakfasts between the head of the Treasury, the head of the Fed for years and years and years. So I know that that did persist after that time. I'm not sure what was going on at the time with Volcker, but I think probably, this is total speculation, but if I'm Carter and I'm totally freaked out by this inflation and I think this is disastrous both for the country and for me politically, and I can't get it under control, I've tried with some of these credit control acts, and here's this guy who says he knows what he's doing, taking the heat, right? So Volcker was despised by the population. It was sort of unusual in today's understanding. Like, nobody really thinks, well, until quite recently, in the US at least, the head of the Fed was not a household name. At that time, it was for sure. And people were not pleased with Volcker. So I can totally imagine a version of the story in which Carter's saying he's trying to solve my problem and he's taking the heat for doing it. But I don't actually know what their personal relationship was like at that time.
What were the international ramifications then of the Volcker shock? Because we're still in a world, we have been from the start of the story you and I have been discussing, in which central bankers are a kind of international brotherhood. I assume back then they were all still men. I don't know when the first female head of a major central bank was appointed. But in that brotherhood, what ripple effects did it have? And then how did that lead more broadly to the international era of independent central banking, which also, in many people's mind, connects with the era of accelerated globalization?
I think that's absolutely correct. I mean, I think that relationship of international globalization and central bank independence is key to the story that we're telling. I mean, one of my favorite researchers at the BIS is a guy named Claudio Borio. And he once wrote this paper that essentially argues exactly this, that central bank independence and globalization spring from the same sort of mindset. And it's the same mindset we've been talking about in this whole conversation, which is that you have predetermined rules that are effectively enforced and that are widely adhered to, and that enables global trade. And it's been long recognized that finance doesn't just sort of exist. It has to have governance. Somebody's got to set up the payment system. Somebody's got to enforce the contracts, etc. So there needs to be some form of governance. We don't have, despite attempts, we don't have any sort of global governance institution that has the power to do that on its own. So what happened? Well, we have domestic central banks that have secured independence from their domestic political governments and therefore have the flexibility to coordinate with one another to establish a decentralized global system of financial governance. Now, it's pretty informal and somewhat fragile, though, because it rests on the markets and market actors trusting that this system will remain in place and actually have the power to execute what it says. So, for example, like the communique I was talking about earlier that came out in the early 70s from the BIS about support for the Eurodollar market. It wasn't a formal policy document. It doesn't even really say that explicitly, but that's the kind of message that people got from it. So it's kind of a fragile system. And most crucially, for the conversations that I'm sure we'll have about today, it rests entirely on domestic governments respecting domestic central bank independence. And so these two things are essential, right? So if you think of globalization as utilizing the Eurodollar as its international currency, and you think of the Eurodollar as being explicitly and implicitly supported by the Federal Reserve, then U.S. central bank independence is obviously foundational to the entire system of global financial governance.
So does it depend on the independence of the Federal Reserve, or does it depend on the independence of all of the central banks? Because it is from the Second World War on a story which is simultaneously a story of increasing global integration and the rise of all sorts of other very significant actors in the system, and particularly after the end of the Cold War when the biggest rival actor falls apart. And so that story has come to an end. Is this still a system which is really entirely dependent on what is happening in the United States? Or is it a system in which that is being increasingly diluted over time? And both of those stories could lead to where we are now, both American paranoia about being subject to what happens in other places and American resentment about anchoring a system that it isn't benefiting from. But before we get to now, can you answer the question of whether this is still really a US system under the name of a global system?
Yeah, it's a great question. I mean, I think in a way it has to be, because until the dollar is not the currency of global trade, the only party that can backstop any dollar crisis is the Federal Reserve, right? And so in that basic sense, it has to come back to the US. But of course, that can crack. We may be seeing that right now. But in another sense, you're absolutely right. And there's an economist who's written on this, Ethan Kapstein, who writes, essentially that American governance fueled globalization, but now it's this globalization that's controlling American governance, right? And so I think you can see this in the sort of 2008 bailouts. So we had the Fed bailing out all these foreign banks because it felt it had to preserve the stability of the domestic financial system. But in a way, some scholars say, well, doesn't that just show that the American state isn't very powerful, right? Like it has to bail out these private banks that are in foreign countries. It can't just say no or else its domestic system is going to collapse. And I think in a way that's right, but I don't think it quite captures the whole picture, because it goes back to this thing we were talking about at the very beginning, right? Which is that there's huge American power in the Fed sustaining the entire global financial system. It's just not domestic political power. So you have to make that distinction. So the Fed is hugely powerful in the global financial system. The U.S. Congress, maybe not so much, except it could tomorrow eliminate the Fed. Is it going to do that? Probably not. But now we have a president that's testing these limits. And you said the burden or the resentment of the Americans of sort of being the center of this system. I mean, I think it's important to point out that for a long time there has been discussion in the economic literature about this being a privilege or this being a burden, the American centrality to the system. And I really think there's sort of two pillars of that centrality. So we have the Eurodollar, which we've already talked about. There's also the treasury market, which provides this massive, usually very deep, usually very liquid market for safe assets that is essentially used like a currency in the international financial system, right? So you have these two sort of monies. You've got the Eurodollar market, you've got the treasury. And what that means is there is a burden in some sense in which the U.S. is the producer of monies for the international financial system. But as a consequence, it makes it much harder for it to be a producer of anything else. So the stuff is made in China, the stuff is made in Germany, we make the money, and then we all exchange it. But for people who, especially most recently, who are really concerned with the U.S.'s capacity to make chips or whatever, that makes that job more difficult. On the flip side, the benefit that's often discussed is when budget day comes in the U.S., absolutely no one is talking about headroom like they do in the U.K., right? Because everyone in the world wants to hold treasuries, wants to hold dollars, so we just don't have that same problem. So there's positives and negatives, right? But it's just this goes all the way back to Keynes's discussion at the very beginning. We were talking about Bretton Woods about, there's a way you could do this internationally, but to pair these imbalances with the political and geopolitical power structures makes it way more complicated.
So just to be clear what you mean by headroom. So in the UK, we don't have headroom. We are very constrained. The current Labour government is very constrained, partly because it's terrified of what the markets might do and what judgment the market might reach about the interest rates that will be required for UK government bonds. Are you saying in the US, you just don't have to worry about that because there just will always be demand? I mean, sometimes the UK Treasury has to worry, is anyone going to buy the stuff that we're offering at the rate we're offering it? Is it really the case that in the United States, no one ever has to worry about that?
Well, I mean, it's obviously a slight exaggeration, and people do raise the alarm all the time, about will we be able to borrow? Is our, debt to GDP ratio too high, et cetera, et cetera. But in the period of time we've been discussing, for the most part, it's true that there's such desire for U.S. treasuries in the international financial system that demand changes the calculus of domestic politics in a much different way than you see happening in the UK.
And yet the thing about that demand is it does also feel like a hostage to fortune for two reasons. One of which is one day, nothing lasts forever, right? One day there will be a limit. And the other is that these treasuries are being held all over the world by people who might offload them. So there's first of all the question about whether the demand will still be there, but then there's the more immediate question about if you get entangled in some real conflict, this thing that you've produced, which is being held all over the world as a form of money, might lose its value very, very quickly if, for, say, political reasons, other national governments decide to dump it. And I know it's thought to be a kind of mutually assured destruction pact, because if you dump US treasuries, what are you going to use as your money? But still, it does feel like it's not just grounds for thinking, well, lucky old us, we don't have to worry about this stuff. At some point, you do have to worry about it, don't you?
I think that's right and that's wrong. There's a common discussion about this where it's like, as you say, nothing lasts forever. What about when they come and call on those treasuries? Or it's a similar argument to things like the central bank in the US. The Fed uses an accounting procedure that essentially defers losses and someday that's going to come back to bite them. If you're issuing what is essentially money, it's not obvious structurally to me that that's actually true. What day is it in the future that David, if I've given you money, that you're going to decide you don't want money, right? Money is the idea is that that's going to keep going. The question is that I think you're right about is there can be changes in political desire, right? Or political action that can all of a sudden alter the attractiveness of the money itself, right? So it's not in the structure of the relationship. It's the fact that the U.S. can do something, perhaps like it's doing now, that will make it look different to the rest of the world. So It seems to me like it's not everything comes to an end. It's that we could decide for it to come to an end. And, this is the stuff that everybody and their mother has been talking about recently, where there's some suggestion in the U.S. that maybe the U.S. will forcibly convert some of these treasuries to 100-year bonds or something where the interest rate is zero. So essentially, effectively default on them. And that would change the picture. But of course, that's a sort of political decision to alter the structure because, ostensibly, the U.S. wants to devalue its currency and become more of a producer and an exporter, et cetera. So it comes back to this balance between the two. And really, it's a push and pull between, are we a global economy and we're going to trust that we're going to continue to be a global economy in a frictionless sense in which the U.S. can be the producer of money and China can be the producer of things, and we will just continue that process? Or is there going to be a political wrench thrown into that picture, and suddenly boundaries and national interests are going to come in to screw it up? But I don't think that's sort of a structural thing in the money. It's more of a political influence.
So I'm going to ask you about Trump in a second, but I want to ask one more question about something you said about 2008, which is a key moment when the Fed reveals that it is willing to be essentially the central bank for the world. And you said earlier that central bankers in the United States aren't normally household names, but Alan Greenspan was, and for a while Ben Bernanke was, in the sense that people knew who he was. And we were always told about him that he was an expert about the 1930s. And he really was haunted by what had gone wrong back then. And of course, one of the things that had gone wrong back then was that private banks had been allowed to fail in Europe. A bank failed in Austria, and the next thing you know, the world's at war. I mean, I don't think it was quite as simple as that, but I suspect that there were moments in 2008 when it was as simple as that. Do you think that's gone, in the sense that the fear, the haunting of the pre-Second World War world, and the failures of international finance and collaboration and the role of central banks, which still seem to be really there haunting them in 2008, do you think it's still there, or do you think we're nearly a century on from that?
I think central banks tend to follow the rule of most institutions that they're always fighting the last war, right? So I think that was definitely the case for Bernanke. I mean, I think that was the case for Powell when it came to COVID, right? So he essentially used Bernanke's 2008 playbook and souped it up. What does that mean for what comes next, right? Are they not worried about that? I mean, I think the international dimension, interestingly, in terms of bailouts and bailouts of foreign banks, that's been there since the very beginning. So in Andrew Jackson's veto letter, right, of the second bank of the United States, he said, I'm worried about this, like foreign connections and foreign influence. So that's been there for a really long time. And I don't think that's going away. Like, as we've talked about today over and over again, like this tension between sustaining international finance and its relationship to domestic finance and domestic politics is always going to be there. So I think what we're facing down that's slightly different, that is interestingly different, is that the Great Depression, the Great Financial Crisis, COVID, rightly or wrongly, I think at the time were all understood as exogenous problems, right? And the central bank is like riding in on their horse to solve the problem. What we're facing right now is intentionally, clearly, and explicitly created by the elected branch of government. So, like, what does the Fed do in that instance? It's meant to be apolitical, but it's also meant to secure the stability of the financial system. How do you do that in that context? So I think in a certain way, they are playing a new game, and your guess is as good as mine.
Well, I'm about to ask you, I'm going to make you guess. So what happens in 2025 and beyond when there is an explicit political conflict between not just the executive, because Congress is, if nothing else, missing in action in this story. And of course, it could be Congress that decides to default. I mean, that's the other possibility, by failing to pass a budget. But what happens when the Federal Reserve finds itself in explicit conflict with the political representatives of the people? Do its loyalties to the international order come to the fore, or does it start to seriously worry that that is its weakness?
The Fed for sure, I think central banks in general, but the Fed for sure has always been really concerned with protecting its independence. And usually what that looks like is paying attention to politics, because that means I don't want you to hate me enough to change my independence, right? Like, I want you to see me as a benefit, or at least not enough of an irritant, because they are very aware of the fact that Congress could get rid of them tomorrow. That being said, it is their complete identity today that they are independent guardians of what they see totally, I think, genuinely as the public interest. But for them, it's the public interest filtered through sustaining the functioning of the private financial system. That's their job. And so if that were to come into explicit conflict with the president, I mean, who knows what's going to happen when Powell's gone and Trump has the chance to appoint a replacement. But Powell, for sure, I think is going to dig in his heels and say, this is what Congress decided. And if the Supreme Court wants to chuck me out, then they can. But I don't think he's going to blink when it comes to a conflict with Trump. I think he's made that pretty clear. What happens next and what Congress will do? I mean, in Trump's last presidency, he tried to appoint some pretty alternative people to the Federal Reserve and was rebuffed by the Senate. So we'll see what happens because, Powell's only going to be, interestingly, Powell will only be chair until May of 2026. But I think his stint on the board is longer than that. So, most board members choose to leave early and definitely don't stay. I mean, that's not completely true in history, but mostly true that they choose not to stay on the board after a leadership position. But we'll see.
So one last question, going back to the beginning of this story, the assumption, as you said at the start, post-1918, which was the dawn of the age of democracy. There really wasn't much democracy before 1918, but there was after, was among central bankers that democracy is a problem for central banks because elected politicians might do things that the people want them to do, and it's our job as central bankers to resist that because the system isn't suited to that kind of volatility, essentially, the volatility of public opinion. It doesn't have to be that way, right? In the sense that if the assumption of this whole 100-year story is there is a tension between democracy and central banking, it ebbs and flows just how wide or how narrow it is. In Britain, at certain points, it's been closer post-1997, an explicit decision by a government that's just won a huge landslide to create almost its first act, Gordon Brown central bank independence. But there are presumably other ways this could be done, and they would be ways that would push back a bit against the idea that the primary role here is to protect domestic interests by protecting the international system. How could it be different?
There's a huge spectrum of ways in which it could be different. So in the UK, it's interesting because some of the infrastructure of like a tighter relationship is already there, right? You see the chancellor is meant to write a letter to the Bank of England every year, sort of fleshing out the ways in which she or he thinks that remit should be executed. Now, that letter has largely been very pro forma since 1997, but it doesn't have to be.
And it wouldn't have been if Jeremy Corbyn and John McDonnell had been in government.
Definitely not, I would imagine. I mean, given what they've said. I mean, even Rishi Sunak was pushing that line a little bit as chancellor. Like, he put climate into the letter for the first time, which, raised eyebrows. But the other thing to mention is that if you look into the details, so there's a great book coming out by a colleague of mine named William Bateman called The Fiscal Fed. And he did this deep dive into the Federal Reserve archives and just documents how actually the Federal Reserve engages in essentially monetary financing, funding the government, making funding easier for the government in various ways at various times throughout the entire history of the Fed. So this is always going on. The question is, how explicitly political is the decision making? And I mean, I've suggested that we should make it much more explicit, right? You should have mechanisms in which the legislature regularly gives some sort of steer, or at least is forced to decide not to give some sort of steer to the central bank to make these decisions explicit. And that is not without historical precedent. This has happened many, many times. We've got this story that's kind of percolated into the public imagination that comes from an economic model about this, which essentially says politicians are just robots, right? They're going to do anything to get elected, and what they'll think is going to get them elected is short-term inflationary policy, and therefore they're just incapable of having their hands anywhere near monetary levers. But of course, that's just not true, right? That's historically not true. Sure, it's happened that we've had bouts of inflation in the past, but there's been huge amounts of time in which we haven't, in which the relationship has been closer. And then on top of that, just analytically, the model doesn't hold up. So if it were true that Congress people in the US today were that short-sighted, then they would just eliminate the Fed and juice the economy, right? Because they can do that. So it just doesn't really hold up as a story. And so I think we need to be much more expansionary and creative in the ways that we think about governing monetary policy and managing this tension, because we've sort of found ourselves in this environment where we're justifying an institution that has developed slowly over history from being a private institution to gaining public power. Whereas if we just thought about what it would look like to invent a central bank today as a public body, it just wouldn't look anything like what we've got. I mean, the Federal Reserve Bank system in the U.S. is actually owned by private banks, right? So, that's just strange. So we just need to be a little bit more creative, I think, in the way that we think about these things.
I think the behavior of the Republican Party in the United States today suggests that it is not the case that politicians only think about getting reelected. They do all sorts of things on principle. I think these are principles, and they may well make it very hard for them to get reelected. Having said that, how would you feel if the legislature did issue more direct instructions, but it was this legislature and the instructions were, we want you to be a wingman in our impending war against China. So start now by punishing them. What safeguards would you have in place against that? Or would you say that's part of democratic central banking too?
I mean, I think there's a few things to say about that. One is, I think you're absolutely right to emphasize the legislature and not the president, because it's the legislature's constitutional prerogative to do that, and absolutely explicitly not the president. So that's just important to say, because this is not giving Trump power, at least in my view. But the two other things to say is, one, all the necessary caveats about, is the U.S. Congress actually as democratic as we would want it to be, gerrymandering, campaign finance, et cetera, et cetera, et cetera. We don't have to go into the details, but one just has to say that because it's true. And then the second thing is, I actually think that this argument sometimes goes the wrong direction. So I actually think that the state of the U.S. Congress and how dysfunctional and performative that it has become is in part because it has essentially been drained of its political power and responsibility. So if it were the fact that Congress actually had to make a real choice about, say, putting someone who believes in going back on the gold standard on the Federal Reserve Board, which was one of the proposals that Trump made in his last time in office, they said no to that. I'm not saying that this Congress is fabulous and will always make the right choices in my view, but real power and real responsibility does change what people actually do in practice. And so I think the fact that we have delegated all this monetary policymaking power away from Congress has actually made the problem worse. And then the last thing I would just say is, as a U.S. citizen, as a single U.S. citizen, I would be terrified by that suggestion. As a democratic theorist, I think if you really truly believe in democracy, you've got to be ready to be governed by people you disagree with. And that's kind of the name of the game.
Coming out tomorrow, we have a new edition of our free fortnightly newsletter to accompany the first 4 episodes in this series. If you'd like to subscribe, it's very easy. Just go to ppfideas.com or click on the link in the show description. Next time on Ideas of Globalisation, I'm going to be talking about something that Leah and I touched on in this conversation. I'm speaking to the economic historian Meg Jacobs about the 1970s and what happened to America, the American economy, and in particular, the impact of the oil crisis. And one reason all of that matters is that Donald Trump grew up as a businessman in the 1970s. How did that decade shape the person he is today? Do join us for that. This has been Past, Present, Future, part of the Airwave Podcast Network.